Well, Kevin, thank you so much for joining me. I'm here today with Kevin Caron. He is a senior portfolio manager at Washington Crossing Advisors, and I'm very excited to be chatting with him today about a topic that I think is really on the minds of at least most of my clients, but a lot of investors, and that is inflation. So, Kevin, I'm hoping you could just kick us off by maybe talking about, inflation really hasn't been much of an issue for many, many, many years. And then we have these kind of shocking CPI numbers where last month the consumer price index was up, I think it was 6.2% from a year ago. And I think those numbers really spook people. And so can you just kind of speak to that and talk about
Yeah,
what's going on right now in the current inflationary environment?
sure. So maybe I'd share just a perspective with you and your viewers that over the longer period of time, we've been through this before, but we haven't been through this in quite a while. So if we went back and looked at the 1970s, we had inflation that was roaring in the well above 10%. These days, we've become accustomed to 1 or 2% inflation, but year over year, the consumer price index jolted everybody last month by
Mhm.
showing a 6.2% rise in the inflation rate. So that has caught all the headlines and has brought a lot of attention on this issue. And of course, this means a lot for investors and what to do with your money in the face of all this.
Right. Yeah, I noticed on that chart, it looked like it was 1990 before it was quite this bad.
Yeah, it's you have to go back quite a ways to get a number of like 6.2%. But there's quite a lot going on. There are two things that are at work here that are driving this, we think, at Washington Crossing. The first is the the large increase in the money supply due to relief efforts for COVID. That really has had a significant impact on the underlying value of money. But it's that effect, which when you increase the money supply, you typically see that show up as higher prices, the cause being more money, the effect being higher prices we pay for things at the store. But at the same time, we have all of these shortages and we have bottlenecks in the supply chain. So depending upon how you want to spin it, if you're somebody who's a policymaker and you're looking to point to spin it in a positive way, think that this is just a temporary phenomenon, you're going to point to the bottlenecks and the supply disruptions. But if you're an investor with a longer term horizon and you're concerned about the value of money, you're going to be looking more at things like the size of the deficits that have been run, the amount of money printing that has been happening over the last year or two to deal with COVID, and the longer term and longer lasting effects of that. And only time will tell which version of inflation this is, whether it's the more pernicious longer term variety or whether it's more of a short run phenomenon, which really shouldn't pose too much of an issue for investors.
Hmm. Yeah, it's interesting. So what you're saying is because most of the headlines that I see, and in my own anecdotal experience, I had a fence installed in our backyard this year, and they told me because the materials and the metal that it's made out of, they were like, this is not a high pressure sales tactic, but if you don't make a decision and sign the contract by like next Monday, then the prices are resetting and I can pretty much guarantee you that's going to be a higher price. So if you want to lock in the price now, and it's just crazy. Like I've never had that kind of conversation with someone before about like,
Well,
prices are
did
going up.
you get the fence?
I did.
You're lucky. I tried the same stunt a year ago. My fence, half of it literally fell down, and I went through the same thing. But no lumber was. I wasn't able to get the fence because there wasn't a fence to be had. So
Yeah.
I'm still living with half a fence. So you consider yourself
Yeah.
lucky.
Yeah, and I think, it's funny because most people have similar experiences where they're seeing, prices go up at the grocery store, and then when they watch the news, they're hearing that it's all COVID related bottlenecks. They see photos of all those big cargo ships just like sitting out in the off the port of Los Angeles. But you're saying that there's something else going on here with the money supply. So
Yeah.
can you speak to that? Because I think that's a whole other side of the inflation issue that isn't really talked about very
Sure.
much.
Okay.
or well understood.
Yeah. So let me show you a chart that we just published on our website at Washington Crossing, and essentially what we're looking at it are three charts here. And sorry, in the top, what you should see is money supply growth. And here we're measuring the amount of dollars in existence. So if you doubled the amount of money, all else being equal, you would expect each dollar to be worth half, and prices, all else being equal, would be double. The worth of money declines as you issue more of it. So over the last 2 years, the money supply has been growing at a rate of about almost 20%. But the amount of the ability of our economy to produce stuff is represented in the second chart. And this is potential GDP growth. It's not the actual GDP, but it is what we should be able to produce given our underlying resources and productivity. And what you see is that we have a lot of excess money growth. In other words, we're producing a lot more money than stuff available to absorb that money. And so consequently, anytime the amount of money does not keep up with the amount of stuff, then what you're going to see is rising prices. If you had the amount of money grow at the same rate as the stuff, you would essentially have level prices. And if you had the amount of stuff growing faster than the amount of money, you would have falling prices. So we are focused as long-term investors on this phenomenon because this is something that can be very dangerous and has to be watched from an investment perspective for a long-term investor, whereas the shorter-term issues tend to work themselves out. We had a lumber, you talked about fences. So you had a big spike in lumber prices last summer where lumber prices quadrupled. It created an enormous incentive for the world to supply lumber, and that incentive worked out. So all of a sudden, lumber was then brought back into the market. You were able to get your fence. I was not able to get my fence. And consequently, the world is moving towards a place where we can all have lumber again. So we don't worry so much at Washington Crossing about those short-term dislocations. They tend to work themselves out. But these longer-term inflations caused by essentially a printing press, that's something that we have to be very much concerned about, especially for longer-term money that we're investing.
So the Fed and policymakers and the people in the federal government writing these checks, I mean, some people might make an argument that they're stupid, but they're generally not stupid. Like they're looking at these same charts as well. So what, and I've started to hear things from the Fed about, what they're going to do to deal with this, but maybe I've missed some things, but there hasn't been it doesn't seem like they're that concerned about it. And so I guess my question is well, who's going to curb inflation and how, and can that be done? Is it likely that would be done?
Well, I have to point out this is nothing new, and the trouble with inflation is that it's pernicious. It provides a way for government to pay for things, politicians to pay for things, without having to raise taxes or without having to issue more debt to the public, both of which are hot button issues and they don't really help at the polls. They're not things that are very friendly to a politician. But if you can issue money, well, that happens kind of quietly on the side. So last year, when the Treasury sent out relief checks, that was fantastic because we had a lot of people were suffering, and from a point of view of a politician who wants to provide relief and show sympathy for people who are struggling, that's a fantastic way to deliver it. And if you can have the Federal Reserve, one branch of the government, buying up bonds issued by the Treasury, another arm of the government, and then use those proceeds to write checks without having to raise taxes or to issue more debt to the public, that's a wonderful recipe for anybody who's holding office. So there's a long history for this to happen. It's a tendency, and it's happened in our country in the 1970s, in the U.S. Confederacy, in the mid 1800s, the continental currency, and when we became when we were a young country in the 1700s, France went through it. China with Chiang Kai-shek in the 1930s went through it. Bolivia, Brazil, Argentina, Russia, Germany, Hungary, Italy, United Kingdom, France, Yugoslavia. All these countries have experienced this. Rome, the Roman Empire, experienced it years and years ago. So there's nothing new to the allure of using printed money to pay for a politician's agenda. And it's very hard to wean off of, because it's such an easy way to deliver to the public what they want. In this case, this year, or last couple of years, it's been relief for the COVID pandemic.
But then they have to deal with the backlash when people are starting to get very upset about their grocery bills a lot higher, gas prices are higher. A lot of people who want to buy a house right now can't afford to buy a house. You can't afford to, if I wanted to sell my minivan right now, I could probably get more for it than what I paid 2 years ago when I bought it. So it's like there's a backlash, everything kind of will come full circle at some point. So I would think that and it seems already that's getting politically unpopular to continue with the just injecting more money into the system. But so is that concerning then to you, that it becomes more likely at this point than maybe we thought? Or I don't know what you thought earlier in the year. Did you think like January 2021 that inflation would be a lot more transitory? Did you foresee that by the time we got to October it'd be up 6.2% from a year ago? And what did you think, and how is that how is your thinking changed over the year?
Well, as the year went on, it was becoming increasingly obvious that we were starting to see this pressure and growth in the money supply, and we're very attuned to that, and we write a lot about that in our commentary. So it has been something that we have been cautious about, but the way that we're cautious about it in the portfolios we manage, we're very attuned to what tends to happen when you have when you invest in companies that, for example, have very high valuations, lots of growth prospects, and you end up with owning companies at very high multiples where a lot of the value of that company is tied up years and years or decades away. We want to be very careful about that as a value investor, so we try to stay away from that especially whenever we see inflation.
Mm-hmm.
The second thing we want to do is we want to be mindful that interest rates are at that's not even decades, it's hundreds or thousands of years we've not had negative or 0% interest rates in the world. So we're very conscious of the fact that we are living in a unique environment where you've got this very cheap cost of money. We don't want to own companies that act like bonds, because if you have inflation, what the worst asset class to own would be long-term bonds. And therefore we have to be very careful buying stocks, that we're not buying stocks just to own a yield, which some investors do, and they can end up in the trap of owning essentially a stock that behaves like a bond, which is usually not something you want to own when there's inflation, because it erodes the future value of the bonds, especially if interest rates rise. Mm-hmm. So we have been conscious of it. It has been a very complicated 2-year period with wild swings in growth, given the shutdown and the restarts, things that have not happened before. There's a lot of moving parts here. But when we think about where the risks are, those are two risks that come to mind. Don't overpay for growth, basically, and be very careful here about owning stocks that act like bonds.
Interesting. Yeah, and that was another question that I had, that I have conversations with clients all the time, especially clients who are retired, who are nearing retirement, which is who this podcast is geared towards. And, on the one hand, they don't want to be 100% in the stock market. They don't have that kind of appetite for risk anymore that they might have had 10, 20, 30 years ago. And so in this environment where you're looking at where an environment where bonds potentially are not going to be a good place to invest. And even if you invest in short-term bonds that aren't going to get clobbered, I mean, the yields in them are just horrible. They're so low. Um, what is a bond investor to do in this type of environment?
Yeah, all right. So this is one of these situations where there's going to be a fork in the road, and it really depends upon which way things go. So let's play it out both directions. If this inflation turns out not to be transient, if it's not just about some bottlenecks at the ports, if instead it becomes entrenched in policy and we end up with a printing press problem that goes on for a long, long time, and we end up with a protracted inflation, then in that case, what you want to be doing is you want to be thinking about shortening your duration in your bond portfolio, because it's very likely that interest rates would come under pressure to rise in that environment. The Fed would be under a lot of pressure to increase interest rates in that environment. So it would tend to suggest that you would want to be shortening your duration. In other words, owning bonds that don't come due that far off in the future, or at least owning bonds that have higher coupons associated with them. Oftentimes it means you'd have to pay a premium for those bonds, but a combination of owning higher coupon bonds or shorter term bonds to maturity, though, that would be one way to ease some of the pain that a bond investor might feel. The other way you could do is just think about diversification, because bonds are a piece of it. And if you're in the presence of inflation that's continuing, then things like hard assets, gold, for example, or real estate make a lot of sense. Your minivan, stocks tend to work if we have a moderate amount of inflation, but if it gets too hot or too cold, stocks can become a problem. Right now, we don't see it as being a real big issue. But ultimately, owning a mix of stocks and bonds and cash, and maybe some hard assets thrown in there just for some insurance, would be the thing you would do if you really were concerned about a long-term inflation. So that would be scenario one. The other scenario is that the inflationary boom is followed by an inflationary bust. You can imagine this playing out maybe if the Fed comes under a lot of pressure to raise interest rates. They stop the asset purchases faster than the market expects. They rush to raise interest rates much faster than the market expects. That causes a tightening of financial conditions, and then you would expect to see a decline in stocks and maybe a rise in bond prices as interest rates rise. If that's the case, then what you need to be concerned about is more the bust that comes with a deflation following inflation than the deflation that might be brought about by excessive tightening. And if that's the case, you want to make sure that you own very good companies with very low debt on their balance sheets. You want to own companies that have a lot of financial flexibility, lots of cash flow, because ultimately it would be that bust period where it might be painful, but the market will serve up some very good buys. So you want to have that kind of flexibility in the portfolio. And we just don't know which one of these two paths we're on at the moment, but we have to be prepared for going one way or the other.
Yeah. Well, Kevin, do you have any final thoughts or anything we haven't covered yet?
Yeah, I just think ultimately, if having a very good financial plan, one that has inflation at the core, to think about your long term, to think about what you need to do in terms of saving and investing to get you there, is very important. And it wouldn't hurt to revisit that plan and challenge the inflation assumption. If you have to live through a period of retirement, or you're saving for retirement, it's not so much the money that you have now and the prices that you have to pay now, but it's the money and the prices the money that you're going to need and the prices you're going to have to pay when you need it. And if that time is far off in the future, you need to be thinking ahead for that now. And it might affect your withdrawal rates. It might affect how much you're saving. It might affect some of your spending plans. But all of that is important to test in the event that we end up in a situation where we do have some higher inflation.
Yeah, and that's what really concerns me the most. I think when I look at client portfolios and trying to construct and maintain those portfolios and position them in the right way is that if we have higher inflation and it sticks around for a while, and that's hurting your bond portfolio potentially, it could be damaging for the stock portfolio too, again, depending on how they're invested. And so when you couple the need to withdraw more with a portfolio that's not growing in the way that you expected, or is declining in the case of like owning longer term bonds, I worry about that kind of double-edged sword that retirees have to deal with in an inflationary environment. I think that's what makes it so scary, especially for retirees who are trying to live off of their hard-earned savings.
Yeah, very, very much. But planning ahead, thinking it through, making conservative assumptions. If it ends up being that we don't have inflation goes away and it rolls over, and you're living on a fixed income. If you overestimate and it turns out to be not as high a rate of inflation as you might imagine in your plan, it's not the worst thing. What you don't want to do is you don't want to underestimate that.
Yeah.
So to the extent that you can, you should try to stress test your plan to make sure that you're on the right track, or you have to stand the best chance of landing where you want to land.
Yeah. Yeah, I had a prospective client the other day who had done very well in managing their investments, and they wanted me to use in our projections for retirement a 10% annualized rate of return for their entire portfolio. And I was like, I don't know about that. I don't think that'd be prudent, but so I think investors have, especially ones who have been in the market, have done very well and have different expectations about maybe what the next 10 years might look like versus maybe what reality is pointing to.
Yeah, our take on that is that there are a lot of good things happening. We do have growth in the economy. There is some amount of, I'd call it healthy inflation. Maybe at the moment this is a little too hot. I'd like to see it come down a bit, but we do expect some maybe 2% or 2.5% inflation. We do expect investors to receive income in the form of dividends or share buybacks, and all of that is very good. You could get to 7 or 8% returns if that were the case for stocks, generally speaking. On the other hand, we're also coming at it from a point where the stock market is at a record high. We're trading now with a value of the US stock market well above $50 trillion. To put it in perspective, just over 10 years ago, that number was closer to $10 trillion.
Wow.
So we've had a huge run in the value of stocks. It's embedded in there are a lot of expectations about things like a low and cheap continued source of money, source of capital, not a lot of opportunities to go elsewhere like cash or bonds, given the low yields, a fairly healthy amount of growth, some very high earnings. If you look at earnings, despite all the talk about inflation, earnings for the S&P 500 forecasts are the highest they've ever been. Mm-hmm. So for all the belly aching about companies not being able to make profit in this, the reality is that companies are actually, their forecasts are fairly strong in terms of their profitability. But given that we're starting with a high valuation point relative to earnings or GDP, we are thinking that those multiples, those valuations probably come down over time and weigh on returns. So our expectation would be a low to mid single digit kind of return for stocks. That would be our best guess over the long term. If it turns out that we're wrong and it ends up being 6 or 7 or 8%, great. If you plan around 4 and you get 6 or 7 or 8, that's fine. What we don't want to be is overly aggressive. So that 10% number that you threw out there, that to us seems a little bit. It would be hard to get there. Would it be impossible? No. But would it be hard to get to that number? It would be, in our judgment. We wouldn't use that as a base case for doing financial planning.
Right.
Yeah.
Well, Kevin, thank you so much. I always enjoy talking with you, and I really appreciate your insight.
Likewise. Thank you for having me.
Yeah, my pleasure.